and welcome to Think and Link series. I am your host, Srinivasan. Now, India's financial sector is facing a storm on two fronts. Maharashtra government's sweeping farm loan waiver and Bihar's proposed cap on microfinance borrowing. This may bring relief to millions, but they have clearly rattled the markets and raised very tough questions about credit discipline. So let's dive into how politics, policy, and portfolios collided this week. Point one, Maharashtra's waiver, that is Maharashtra government's waiver and market fallout. On Friday, Maharashtra government rolled out Punyashlok Ahilyadevi farm loan waiver scheme, writing off crop loans of up to rupees 2 lakhs and rewarding disciplined farmers with a 50,000 incentive. The package, worth about 35,000 crores, is expected to benefit nearly 5 million farmers. Well, that's fantastic. But the announcement sent shockwaves through Dalal Street. On Monday, the Bank Nifty plunged 3.1%, its steepest fall since April last year. State-run lenders bore the brunt, with Union Bank, IDFC Bank, and then Federal Bank sliding over 4%. Analysts say that PSU banks with their heavy exposure to agricultural loans are most vulnerable. Foreign investors already in a risk-off mode added fuel to fire by selling large private banks. Second, segment 2, credit culture concerns is what is going to get affected. Now, beyond the market reaction lies a deeper worry. Credit discipline. Now, Suresh Ganpati of Macquarie warns that waivers often lead to higher NPAs as borrowers lose incentive to repay. He recalls how SBI's farm NPAs spiked to 16% in FY20 after similar waivers. Nitin Agarwal of Motilal Oswal adds that while waivers may temporarily reduce overdues, the long-term repayment culture could erode, especially with PSU banks already carrying agriculture NPAs of around 17% in Maharashtra. Point 3. Now, this is where the Bihar government comes in. Bihar has tabled a bill to cap microfinancing borrowers. And what have they done? They have very clearly stated that a borrower cannot take loans from more than 2 MFIs at a time, that is, microfinance institutions. The total interest payable is also capped at 10% of the principal amount, and mandatory state-level registration with the Director of Institutional Finance is required, even for RBI-registered entities with a 90-day verification window. It also bans coercive recovery practices, intimidation, and harassment of borrowers. Special courts will be established in every district to handle violations, with the state accounting for about 15% of India's microfinance portfolio. And this move is pretty significant. And this is going to create a riot probably in this MFI sector. India Ratings and Research cautions that such caps could disrupt operations, weaken repayment discipline, and increase delinquencies across the sector. For microfinance institutions which depend on tight repayment cycle, this could be a major blow. Point number 4. Together, these developments highlight a recurring dilemma: how to balance social welfare with financial discipline. Loan waivers and borrowing caps are politically popular, yes, but they risk creating moral hazard, where borrowers expect a relief rather than feel compelled to repay. And when banks carry the heaviest of the weight in benchmark indices, any shock to credit culture quickly spills over into the stock market. As Maharashtra and Bihar push ahead with populist relief measures, investors and analysts are left asking, can India's financial system deliver compassion without compromising discipline? This answer will shape not just the rural credit, but the stability of India's banking sector for years to come. So, with this, we end our this week's episode. I'm sure that you all must have enjoyed this. Please share, like, and subscribe this particular channel. Meanwhile, see you in the next episode of my Think and Link series. Bye bye. Ciao.